So good morning, everybody. Once again, we are going to be looking at the topic money market hedge and forward market hedge. Yes. So money market hedge. The question is, we all know what hedge is all about. Hedging is a way of guarding against foreign exchange fluctuation when they are likely to occur in the market. So when we talk about money market hedge is, is a technique that is used to lock in the value of foreign currency transaction. You lock in the value of a foreign currency transaction in a company's domestic currency. So whenever you're trying to solve questions on money market hedge, you look what is the home currency and what is the foreign currency. So the concept with money market hedge is created by borrowing or making a deposit. So by the time you want to hedge using money market, is either you borrow or you deposit. We are going to see the two scenarios where these two activity plays out. So the essence of this money market is for you to borrow or make a deposit of money now, to fix payments and receipts in a domestic currency. So the money market is a market where market participants can lend and borrow money for a short period of time. So the period of time can be overnight and it can be up to a year. So these money markets, I'm not going to speak too much grammar. I'm just going to show you the steps you need to solve questions on money markets. But take note, money markets is a way you hedge against fluctuation. For example, you are here in Nigeria. There is possibility of you receiving money in the next 2 months from somebody in US. What will you do if you are to receive money in US from US? You can quickly lock or guide against fluctuation in the foreign currency rate by quickly borrowing in US dollar. By the time you borrow in US dollar, that money you borrow in US dollar, you convert to Naira. You convert to Naira. When you convert to Naira, what do? You deposit that money in a Nigerian bank today. You deposit that money in a Nigerian bank today. That deposit you are making will yield some interest in the long run. So by the time your customer in US is now paying you, they are paying you in dollars. You are using that money they are paying you to offset your debt, to offset that money you borrow. So that is one concept of money market hedge. And also, if you are the one to pay, somebody in US, what will you do? You can quickly make a deposit in that foreign currency in dollars. You make a deposit in dollars. So that money you are depositing will yield some interest that will make up the amount you have to pay your customer over there. So when you have to make payments, you make a deposit in foreign currency. When you make a deposit in foreign currency, now all these are just steps. When you make a deposit in foreign currency, what do? That amount you want to deposit in foreign currency, you convert back into your home currency. When you convert to your home currency, what will you do? You borrow that equivalent in Naira. That money you are borrowing in Naira will also yield certain interest. So once it yields certain interest, that will equal what you've deposited. So in that way, you've locked in the exchange rate fluctuation, that no matter how naira and dollar fluctuate, what you've agreed upon today will be what you are going to pay. So, and that will not affect your transaction. So without much ado, if you didn't watch yesterday's video, these are the steps involved in money market hedge. These are the steps involved in money market hedge. Now, we said there can be two forms. Either you are making payments or you are expected to receive in future. Now, the steps involved, if you are the one making payments, you want to make payments. If you want to make payments, the question is, if you want to make payments, it shows that you are being indebted. That is a liability. Now, the payment you want to make is not now, but in future. In future. Now, once you identify how much you want to pay, let's say you want to pay 300,000 in the next 3 months. It means you need to make a deposit now. That deposit will now grow to 300,000. Please look at the screen. You see box 1. In case it's not edible, the slide is on the platform. I forwarded it there yesterday. You can see it from there. This box you want to pay in future. You make a deposit that will grow up to this value you want to pay in future. Now, when you are making a deposit, the deposit you will make will not be 300,000, will be less than 300,000, because that deposit will yield interest that will amount to what? That will amount to 300,000 in the next 3 months or in the next 6 months. So how do you determine how much you are going to deposit? How do you determine the value you are going to deposit? Let me go to the next slide. Okay, fine. How do you determine the amount you are going to deposit? It will be the amount you want to pay in future divided by the rates. The rates, that is, the rate will be what? 1 plus R. So for example, you want to pay 300,000 in future and you need to make a deposit now. How much will you deposit? It will be 300,000 divided by 1 plus R. And R will be given to you in the question as the borrowing rate or deposit rate. So if you are making the deposits in foreign currency, it will be given to you in the question. This is the rate. If you are borrowing in foreign currency, it will be given to you. If you are making the deposit in home currency, it will be available in the question. So the first thing is, in foreign currency, how much are you paying back? How much will you deposit now? Take note of that for foreign currency. So please, in case you don't have this, draw this in your book. You will use this to solve a question whenever you are trying to make a payment. So now, the first step is, how much are we paying in future? How much do we need to deposit now to offset our future payments? And how much you need to deposit now will be this box 1 divided by what? 1 plus R. Now, the amount you deposit now in foreign currency, the amount you deposit now in foreign currency, you will need to convert that amount in foreign currency to your home currency. You need to convert that value to your own home currency, to the home currency. And how do you convert? In the question, you'll be given spot rates. You know, spot rates is the rate of conversion now. If you want to make any conversion as of now, the spot rate is what you are to use. So you'll be giving the spot rate, and the spot rate given will be for you to buy a currency and for you to sell. Now, if a bank wants to buy currency from you, what rate will they buy? Now, this is a question. If a bank wants to buy
At low rate.
They
the
buy
lower
at lower
at,
rate. Sorry,
at
lower rate.
lower rate, at lower rate. So now, if you look at the way they used to express the quotation, the lower rate will always be at the left, the higher rates will always be at the right. So by the time you are bringing this value, your foreign currency that you plan to make a deposit, you want to convert this value to your own home currency. By the time you want to convert this value to your own home currency, what is happening now? You are bringing the foreign currency to your bank. The bank will buy at a lower rate. So you are converting at this point now, you are converting based on the spot rate. You use the value on the left, which will always be the lower value. So when you convert this foreign currency to lower rate, you will get the amount in your home currency. So this value you have obtained in your home currency, you borrow the equivalent. When you borrow the equivalent, you are going to pay interest on the value you are borrowing. So when you pay interest on the value you are borrowing, it will now grow to the total payment here. So what will be the interest? What will be the interest? The interest will be the value in box 3 multiplied by what? The borrowing rate. The borrowing rate will be what? Box 3 multiplied by what? 1 plus R. Box 3 multiplied by 1 plus R. So this is for payments. If you are making payments, you quickly make a deposit. How much will you deposit now in the foreign currency? Then you quickly come and borrow the value you want to make deposit for. Then you do your conversion. Let's quickly look at a very simple example. Please drop this in your book, should in case you don't have it. Write these steps in your books. Then we follow this step one after the other to see the way it works. Now, this is a question. That's a very simple one to buttress what we said. Okay, this is receive. Receipt. We just explain payments. Let's look for a payment, the one that have payments. Receipts. This is also receipt. Okay, let's explain the one of receipts likewise, so that we just solve randomly. So when it involves receipt, now you are the one expecting money. You're expecting money from a customer that you send goods to the customer who is not in Nigeria. Now, by the time you are expecting money in the next 3 months, you can quickly go and borrow in that currency. You're expecting dollars, you're expecting pounds, you can quickly borrow in pounds, you can quickly borrow in dollars. Now, the essence of borrowing is that by the time that customer is paying you that particular sum of money, you are using that money to offset what you've borrowed in the foreign currency. So if you are expecting money from a foreign currency, now the question is, how much are you expecting? If you are expecting 400,000, that is your receipt, your future receipt. You can quickly go and borrow in that value. You borrow in that value. And when you borrow in that value, you can convert that amount you borrow to your own home currency. To your own home currency. Now, when you are bringing your foreign currency to your bank, to your own bank, the bank will sell your home currency to you by collecting the foreign currency. Now, by the time the bank is selling, the home currency into you. At what rate? What spot rate will they sell? Is it at the lower rate or the higher rate?
The higher rate.
Higher,
The higher rate.
higher.
The higher rate will always be on the right. Will always be on the right. So if you look at this value here now, this foreign currency, when you convert to spot rate, you use the right amount. That is the higher value. The higher value. Because some question will not put it the way I'm saying it. Some questions will put it in form of spread. They will just give you a value and put plus or minus 0.004. So when you see plus or minus 0.04, the base amount given plus 0.04, for example, will be the higher amount. The base amount minus 0.04 will be the lower amount. So where the question is not giving you the way I've explained that the value on the right will be the higher, the value on the left will be the lower. Know that the higher value will always be at the right, and that is what you use to sell. So by the time you are bringing your own foreign currency, the bank will collect your foreign currency and sell the home currency to you. So now this value you converted at the spot rate, you make a deposit now in your own home currency. When you make a deposit, your deposit will yield certain interest, which will result into what? The total payment, which will result into the total payment. So the simple analysis is, how much are you expecting in future? 400,000. How much will you borrow now that will lead to this 400,000? It's just you saying that, okay, the amount I will borrow now, divide by what? The interest rate of borrowing. It will give me this value here. How much am I borrowing now? I need to quickly make a deposit of that amount in my own home currency. When you make a deposit of that in your home currency, deposit will definitely yield interest, and that will result into the total payment here. So now, looking at this question, that Anike Limited, a US company, is due to receive. Now, you want to receive 8 million in 3 months. The foreign spot rate in SY a dollar is 3.5460 to 3.5480. The interest rate in money markets are as follows. The interest rate in money markets are as follows. So now, when you want to make a deposit, take note, these deposits and borrowing rates, you can see per annum. By the time you are giving 3 months, how will you get the deposit interest rate for 3 months? And you are giving per annum value. It will be 3/12, right? Multiply by this 5%. Don't just go and use this value directly. Always follow. If it is 6 months, it will be 6/12 multiplied by 5% to give you the interest rate for 6 months. That is, you prorate in that order. Now, we have deposits per annum in SYZ, deposits in dollars. We have borrowing rates in SYZ and borrowing rates in dollars that calculates the hedge value of the transaction. Calculates the hedge value of the transaction. Now, to do this, we can quickly follow the format we displayed earlier on for receipt. You can follow the format we displayed for receipt. Now, from the format we displayed for receipt, the question is calculate the hedge value of the transaction. So the hedge value of the transaction hedge value of the transaction. Please hope you have the question so that you follow very well.
Yes, sir.
You have the question. This is the question, please, so that you understand everywhere we are picking our figures from. So this is the question, should in case you don't have it. So we'll follow that format. Now, based on that, on the format, you are expected to receive how much in future? How much are you expecting?
8
8
million.
million.
In, okay, in the next how many months?
In the next
3
3
months.
In the next 3 months. So based on this format here, I don't think I will even solve it. Based on this format in your book, you can see receipt, right?
Yes.
Receipt.
Yes.
So in this receipt, write how much are you expecting to receive? 8 million. Write 8 million on this part of the box. Write 8 million. Write 8 million. Write 8 million. Sorry, I've woken you up from your sleep. So write 8 million. Write 8 million. You are expecting 8 million in the next 3 months. Now, based on this format, what do you need to do now? What do you need to do now? Look at the screen. You see what you need to do now. Borrow.
We need to borrow.
You borrow. In what currency?
In
In
foreign
foreign currency.
dollar.
So let me put it here. Foreign currency. You borrow in foreign currency. You borrow in foreign currency. So now, right now, we need to borrow in foreign currency. How much are we going to borrow? Let me go back here. How much are we going to borrow? You are going to borrow how much? You are going to say
8 million.
8 million divided by what?
1 plus I.
Ah,
So it will be 8 million. 8 million divided by. From the question, if you are borrowing in foreign currency, what will be the rate? Look at it. If you are borrowing in foreign currency, what will be the rate?
The rate is
5.5%.
5.5%.
5.5%. 5.5%. Because your own home currency, is what?
Your uncle is
Is
US.
SYZ.
Yes.
SYZ. That is your own home currency is dollar, but the foreign currency is SYZ.
Yes.
Yeah. So look at it now. If you want to borrow in SYZ, what is the rate? See it. 5.5, isn't it?
Yes.
Yes.
5.5. 5.5. So the expression will now be in what form? Will now be the borrowing rate will be what? 1 plus R. 1 plus R. But the question is, what is R? The R will be what? The R is 5.5%
5.5%.
multiplied by 3
3
over
over
12.
12.
3 over 12. So when you do this and divide by 8 million, what will be the result?
7,891,492.
So the outcome will be what? 7,891,492. So now,
Are you using Omo to watch this ones?
so now, it has now been clear that for you,
Is it Omo that used
for
to
you,
watch this ones? Oh.
it's clear that for you to get 8 million in the next 3 months, how much do you need to borrow?
7,891,492 XYZ.
Yes. So if you borrow 7,891,492, now it will result into what? Into 8 million in the next 3 months. That is plus your interest. So you can borrow 7,891,492 now. By the time it is 3 months, it will lead to what? It will have grown to 8 million, including your interest. Now, this value you've borrowed, what will you do with it? You can make a deposit in your own home currency. And what will be the deposit in your own home currency? Before you know how much you deposit in your own home currency, you convert this amount you borrow into what? Into your home currency at what rate? At the spot rate.
Yes.
At the spot rate. So your home currency is what? US dollar. Home currency. Home currency. Now you are converting 7,891,492 to your own home currency. At what rate now? At the spot rate.
Yes, the
At the
higher,
spot rate. So is it the lower one or the higher value?
the higher value.
The higher value. The value on the right. See it here. It's already made clear. Spot rate at the right, the higher value. So when you convert this, your foreign currency to your own home currency at the spot rate using the high value, what will be the value in your own home currency?
2,224,209.
So we have it as equal to 2,224,209, right?
Yes, sir. Dollar.
Now, yes. So these amounts you've converted to your home currency. You make a deposit. When you make a deposit, your deposit will earn how much interest in your home currency. So when you make deposits, this is the rate. Deposits in dollar will be at what rate?
3%.
3%. Now, this amount you have here, when you deposit this value in your bank, what will be the value in the next 3 months? What interest will accrue to this in the next 3 months?
There is $2,240,891.
Okay, so that is 224,209 multiply by what?
By
1
plus R.
1 plus R. And what is R? Is 3% multiplied by 3/12. Multiply by 3 divided by 12. When you do this, you have what?
2240891.
Yes.
891. So now, this is the value in your own home currency that you will need. So most questions will give you forward rates. They want you to compare between forward rates and money, between forward hedging and money hedge. Which one is better? Which one is better? Now, this is in terms of receipt. If forward rate will give you the highest receipt, you give an advice that you go with the forward rate. If money hedge will give you the highest receipt, you go with it. If it is in terms of payment, if forward hedge will give you the lower value, you tell an advice, let's go with forward. If money hedge will give you the lower value in terms of payment, you go with the money hedge. But if it is in terms of receipt, the value or the technique that is giving you the highest value will be the one you have to advise the organization to go with. So this is the step to hedge. So this is the step we need to follow to hedge when it involves receipt. When it involves receipt. You're in this class, you are yet to get what we've done. Can I see your hands up so that I do a recap? Because after this, you're going to solve one question. So you don't understand what's okay. Can I hear from you? What is the issue? Madam Choma.
Sir, network threw me out, so I wasn't getting it.
So, Madam Rose. Madam Rose, tell me what happened.
Okay. I got lost. The 8 million we have, divide by 1 plus 5.5. My calculator is not giving me the amount. The 7.8.
Okay. So I will do everything together based on those two questions. Now, based on the question, we are expected to receive 8 million in the next 3 months. And if you're expected to receive 8 million in the next 3 months in a foreign currency, you can quickly go and borrow in that foreign currency. How much will you borrow now that will lead or result to 8 million in the next 3 months? How much are you going to borrow? It's 8 million divided by what? 1 plus R. Your R is the rate given to you in the question. Now, the borrowing rate in the foreign currency is given in the question as 5.5%. Now, this 5.5% is per annum, but you just need the value, the borrowing rate for 3 months. For 3 months, it will be what? 5.5% multiplied by 3 over 12. And this will give you what? So, Madam Rose, in your calculator,
Okay,
you
sir.
can say 5.5 divided by 100.
0.55.
Multiply by 3.
Okay.
Divide by 12.
12. Okay, sir.
Plus
Plus 1. Okay, I have 1.01375.
So just write that value somewhere. Then use that value to divide 8 million.
8 million. Okay.
Yes.
1, 2, 3 divided by 1.01375. Okay, sir. Thank you, sir.
So these amounts you have in your foreign currency that you need to borrow in your foreign currency, you are not there. You don't have it. What do you need to do? What do you need to do when you borrow? For you to borrow, you quickly make a deposit.
The deposit.
That you have to borrow. And for you to make a deposit of this value that you have to borrow, you need to convert this value that you have to borrow to your own home currency. To your own home currency. And when you are converting this value that you have to borrow, your own home currency, because the bank will sell, the bank will sell to you. You are bringing foreign currency, the bank is selling home currency. The selling rate will be the higher value, the value at the right. So by the time you do this, you divide 7891492 divide by what? The rate. This rate here, 3.5480, to get the value in your own home currency. And when you do that, you're going to have what? 2,224,209. This is the amount you need to make a deposit in your own home currency. This deposit, it will not just be there. It will grow. At what interest rates? Deposit in your home currency will grow at what interest rate? At 3%. This 3% is per annum. For 3 months, it will be what? It will be 3% multiplied by 3/12 plus 1. So since it's growing, you multiply. That's 2.224209 multiplied by this rate here, and you should have 2,240,891. I don't know if this is clear.
Yes,
Yes,
sir.
sir. Thank you.
Thank you, sir.
All right. So now,
So please, excuse me, sir. Please, I do understand that table. I did not get the table clear, please.
this table,
Yes, yes, sir.
this table is showing how much you need to receive in future. Table 1, this box 1 here, receipt. It means when you are trying to receive money in future, it means that it's an asset coming to you. Future value of any amount you are expecting. Based on the example we've solved, we are expecting how much? 800,000, which is an asset. Now, this 800,000, you can quickly create a liability for it. 800,000, creating a liability for it is how much you are going to borrow now. How much you are going to borrow now that will result into this asset. So the amount you are borrowing now in the foreign currency, you need to make a deposit for it in your own home currency. You are expecting 8 million, man. So how much will you borrow now that will lead to 8 million in the foreign currency? And that is this box 2 here. This box 2 here. So this amount you are going to borrow now, it will accumulate some interest that will equal what you are expected to receive in the next 3 months, 6 months, 8 months, depending on what the question is saying. So the amount you borrow in your foreign currency, because you are not there, you need to make a deposit in your own home currency. You make a deposit equivalent to this foreign currency in your own home currency. But for you to know the value in your home currency, you convert this value here, foreign currency value, to your home currency. And the conversion will be at the spot rate based on the high value given to you in the question. You have 8 million naira to borrow in terms of dollars, but what will be the equivalent in your own home currency? And that is the amount you have in your deposit box here. These deposits will not just remain like that. If you are making a deposit, it will remain with the bank. They will use it for transaction and it will yield interest. So this deposit amount will earn interest that will give us a total payment in our home currency. So is this home currency we are now going to compare. If we are giving forward contract or forward hedging techniques, that this value in our home currency, comparing this money hedge with the forward hedge, which is better? Is it the forward hedge or money hedge? So we're now going to make an advice that let's go with the forward hedge. We are going to pay less in our home currency compared to the money hedge. So this boxes is just to simplify the process by saying, okay, I'm expecting so amount in future. I need to borrow now in that foreign currency. What I'm borrowing will be less than what I'm expecting, because what I'm borrowing will yield interest that will equal this. So once I'm receiving the money in the next 3 months, instead of going to the bank to collect it, I'll just use that to offset what I've borrowed. So what you borrow, you convert to your own home currency. Your own home currency will yield certain interest, and this will result into payment. I don't know if this is clear, man. So coming back to this question, we said we need 8 million. We're expecting 8 million in 3 months' time. This is the 8 million. We need to borrow. What will yield or result into this 8 million? How much are we going to borrow? It will be 8 million divided by 1 plus the rate. So 1 plus the rate, when we divide it by 8 million, we're going to have this 7891 in the foreign currency. To convert this foreign currency to our home currency, what are we going to do? We're going to divide this by the highest value based on the spot rate, to get the value in our home currency. So the value in the home currency is this. We make a deposit of this amount. When you make a deposit, it will yield some interest, and this will now result into this value, 2.24891. I don't know if it is clear now.
It's very clear, sir. Thank you, sir.
So now, if it is clear, this question is from your study pack. ICANN study pack, financial management. I will read, then you are going to solve. That a UK company expects to receive 8 million or 800,000 US dollar in 3 months' time. It wants to hedge this exposure to currency risk using money market hedge. Spot's 3-month interest rates currently available in the money market are: in US dollar, you have deposit rates, and in British pound, you have the deposit rate also. The borrowing rates, you have it, and in British pounds, you have the borrowing rate. The spot exchange rate is this. So can we solve using their same approach? Can we solve? So as they are solving, if you know what to do, you can speak to the solution, speak to the question, and tell us what to do as others are solving. I know some persons have solved this before, so you can just speak to it. So what are we going to do as you are solving?
So the first thing is that we know that we are receiving 800,000 US dollar, and the UK is the home currency, while the US is the foreign currency. So once that is identified, then we'll go to our table. So we are to receive 800 US dollar in the 3 months time. So it will appear under the future side 3 months. And for now, what will that 800,000 be? So we are going to divide it by 1 plus R. And our R is our rate. So are we depositing or we are borrowing? So for us to receive, we are going to borrow. For us to receive, we are going to borrow, and we are going to borrow in the foreign currency, so which is 4.250%. So, and that is a year. So we are going to prorate it to 3 months. That is 3 over 12 multiplied by 0.0425. And then we add it plus 1 and divide it by 800 divided by that amount. So our dollar now is 791,589. So are you hearing me?
Yes, I'm with you.
Okay. So after we've gotten how much you're going to um borrow now,
Borrow.
so we now go to our own home currency and deposit the money. So how much are we depositing in UK, which is British sterling. So in our own currency, now we have how much in dollar. We are going to divide it by the spot rate, and it's going to be the spot rate on the right hand side, which is the higher spot rate. So because the bank is buying it from us, so the higher spot rate. And when we divide it, we have 445,213 sterling. So once we have that now, so how much are we depositing in 3 months' time for us to achieve the $800? We're going to multiply it by 1 plus R. Multiply that our figure in sterling by 1 plus R. And what will be our rate? Our rate is in the deposit side. So the deposit of the home currency is 6.500%. We're going to prorate it to 3/12 and then add this plus 1 and multiply it by the amount now. And we get our amount in 3 months' time in sterling, which is 452,448. That's the final answer.
All right, thank you very much. And that is it, a very clear explanation. So, who is still struggling with solving this? Speak out, because you have to get it. Okay. Adam Odunayo. Okay.
Yes, sir. Good morning, sir.
Good morning, ma.
Yes, sir.
So
My
tell me.
network has been showing me out. I couldn't join when you sent the link. My network has not been okay. I just joined not 5 minutes.
Wow, that is serious. Okay. But did you watch the video, ma?
Yes, I watched it last night.
Okay. So can I ask you some questions?
You can, sir. That is if I can remember. I watched it.
All right. So what we're saying is this, ma, that you can hedge using money markets. You can hedge using money markets. The essence of hedging is for you to guide against fluctuation, because when dollar increase, gain more power over naira, and you have a transaction to do in the next 3 months, you don't know what can happen. Dollar can appreciate to your own disfavor. When dollar appreciates, it means you need more naira to offset any transaction you have to do with the dollar. So to guide against such fluctuation, you quickly lock your transaction now, so that when the future comes, you hold on to what you've agreed now, to the to the um to the contract terms you've agreed now, so that you will not need to fear that, do I need more naira to offset my transaction in dollar, in pounds? No, because you've already hedged using money market techniques. And for you to hedge is in two ways. If you are expecting receipt, you will show the approach that is just for you. Once you're expecting receipt, what you need to do is for you to borrow an appropriate amount in foreign currency. And when you want to borrow an amount in foreign currency, the amount you borrow will be less than what you're expected to receive, because that amount you borrow will grow into what you're expected to receive. And for you to borrow, it will be your foreign exposure, that is the amount you're expecting, divide by 1 plus interest rate. So when you determine how much you're to borrow, I believe you can see the screen, man. You're expecting certain value in future, you borrow that amount now. How much will you borrow? Is this amount you're expecting divided by what? 1 plus interest rate. You convert this amount you're to borrow to your own home currency, and the conversion will be what? Amount borrowed divided by the spot rate. The spot rate at the right. Now the amount converted to your own home currency will now be deposited. So you deposit the amount, including interest with a bank, in the home currency. And the amount you deposit will be what? Amount multiplied by 1 plus interest rate. That will yield and result into this total amount here. So this deposit value will result into a total amount that will be the amount deposited multiplied by what? 1 plus interest rate. So for receipts, we compare the final amount with the amount of other hedging techniques, such as forward hedging, and select the technique with the highest amount. That is for receipt. If it is for payment, we select the technique with the lowest amount. And that is what we've explained. Then we've solved an example, and this is now move to a class exercise that we should attempt this. We should attempt this. So this is where we are now. So I'm asking that based on what she has explained, who is not getting those values? For foreign currency, how much do you need to borrow now? Can I get response for those aside routes? How much do you need to borrow now?
795,589.
Okay, fine. So when you now convert that amount to your home currency, what will be the result?
445,213.36.
Very good. So that deposit amount will accumulate to how much in the next 3 months? It will accumulate to how much in the next 3 months?
452,448.1.
448.1. So that is it. So in case you are still struggling with your calculator, you can speak out. This morning, I want you to get it, so I'm not moving fast. I'm not going anywhere, even though I have class by 8.
I'm lost, please.
Madam Joy,
Uh,
don't worry, I'll come to Zara Road and find you. You are lost. So at
Mr.
what
Toto,
point
I'm actually with the calculation too.
okay, at
I
what point, ma'am?
I know how to fix them, but it's the calculation. The first one will be 1 plus 4.250% multiplied by
Yes,
3/12. Yes.
yes.
But I'm battling with the calculation. I'm not getting the correct figure, sir.
Okay, this is what you do, ma'am. So 4.250 divided by 100 will give you what, ma'am?
0.0425, sir.
Multiply by 3.
0.1275.
Divide by 12.
0.010625, sir.
Plus 1.
Times 8.
Plus
Okay.
1.
1.010625.
So write that figure somewhere. Now say 800,000 divided by that figure you have.
800,000. Okay.
Yes.
All right. I got it, sir.
So you now move to the next one. You convert to
All right.
stock.
Yes. It's just this one, the first one that scattered the other ones. Thank you, sir.
So, Madam Joy, tell me, what is the problem? You're just waking up from sleep, right?
no.
So tell me what the issue is.
Oh, in the very first survey that we got S7,891.
The first question,
Yes. Uh,
is it this one?
yes. Okay. There was
7891.
a division.
Yes.
Oh, okay. So now for this second one, going by the question, the rate that we use to multiply, why did we use the 4 250?
Just 1 minute. Let me pick a call, please. 1 minute.
Okay.
All right. So, Madam Jo, I'm with you now.
Okay, sir. It's just to understand why we use the 4.250.
Okay. The foreign currency, how much are you expecting in foreign currency?
800.
800. So, you need to borrow, right? What is the borrowing rate in US dollar, foreign currency? Do you see?
Oh, no, I'm just seeing that it was flipped.
So, that is it.
Yeah.
So, who else is having one issue or the other?
Sorry, can you go back to the question? Mm.
And so actually hooked the last part, the total payment.
Okay.
Yes, sir. I already convert it, but to get my answer is different from what they're getting.
So, that is this point, right?
Yes.
Okay. You can off your mic. So, this is it. This is the value you have to deposit, right? 4545213.36. Now, when you make a deposit, the interest rate will be what? When you make a deposit, what will be your interest rate? 6.500%. So what you do is what? 6.500%. You can just divide 6.500 by 100. Then you multiply by 3, divide by 12. Then once you do that, the outcome, you add 1 to it. You can see it, I've simplified it here. When you do 3 over 12 multiplied by 6.500%, you're going to have this value, 0.01625. So 0.01625 plus 1. The rate will always be 1 plus R. So 1 plus the rate here will give you this value. We give you 1.01625 multiplied by the actual amount you deposited, and this, it will give you this. So can I hear from you?
Yes, sir. Understood. Thank you.
Let's move further. And so as we are going further, you'll be the one to be solving. So this question is one of the ACCA questions that I forwarded to the platform yesterday, that ZPS Co, whose
Hello, sir.
home currency,
Mr. Tope,
I can
I'm
hear you,
sorry,
ma'am.
sir. Let me see the solution, sir, please. The last solution, I'm sorry, sir.
This is it, ma'am.
Okay, sir. Thank you.
So this is a question that most times students, when they see things like this, they begin to ask, what kind of thing is this? So it's very simple, but because our mindset will always, how will I get spot rate? What is all this 6 month forward rate? Is always very simple, and the examiner knows that you don't like it, so they will always test things like this. But so once you know the technique, you just get your marks there very fast. So ZPS Co, whose home currency is the dollar, took out a fixed interest peso bank loan several years ago when peso interest rates were relatively cheap compared to dollar interest rates. Economic difficulties have now increased peso interest rates, while dollar interest rates have remained relatively stable. So ZPS Co must pay 5 million pesos in 6 months' time. The following information is available. Spot rate 12.500 to 12.582 pesos per dollar. 6 month forward rate 12.805 to 12.889 pesos per dollar. It means $1 is equal to these values of pesos. So the interest rates which can be used by ZPS Co, we have, if you want to borrow in pesos interest rates, borrowing rate is 10% per year. In peso, deposit rate per year is 7.5%. Dollar interest rate is 4.5% per year, and deposit is what, 3.5% per year. I'm not interested in all these stories, but explain briefly the relationship between exchange rates and interest rates. Explain briefly the relationship between exchange rates and inflation rates. Note, total marks will be split equally between each part. This is ACCA for you. Calculate whether a forward market hedge or a money market hedge should be used to hedge the interest payment of 5 million pesos in 6 months' time. Assume that ZPS Co will need to borrow any cash it uses in hedging exchange rate risk. So now, this is a case of payment, not receipt. This is a case of payment and not receipt. So in this case, what will happen? How much are we going to pay? In how many months are we going to pay? So can I get a response? How much are we paying, and in how many months' time are we paying?
6
5
months
million
time.
in 6 months.
Paying 5 million naira in 6 months, sir.
In 6 months' time. Now, the
Okay.
question you have to ask ourselves again, which currency is the foreign currency? Which currency is the home currency?
Peso is the foreign currency, while
And
dollar is
then
the
dollar
currency.
is the home.
Okay, very fine. So peso is the foreign currency and dollar is the home currency. Now, if you are to make payments based on the format we've shown, what are you going to do? If you are to make payments, if you are to make payments, are you to borrow or deposit?
Deposit.
Deposit.
Yes.
Deposit.
So you
Deposit.
deposit in the foreign currency now. You deposit in the foreign currency now. But how much are you going to deposit? Let's go back to our question.
5
We
million.
need, yes, right on, right on. Right on,
Sir,
ma. How much are
continue.
you? No,
5
you have to.
million. 5 million divided by 1 plus the rate.
Okay, and what is the rate?
7.5. 7.5%.
Multiply by what? How many months?
months.
Divided by 12.
You see now, you've passed. So now, that amount, what will be the result of that amount when you divide?
4,819,277 peso.
Peso. So what will you now do with that peso that you have?
You borrow.
You borrow in your own currency.
You
You
borrow in
borrow,
your home.
yes.
So when you want to borrow in your home currency, what will you do with that peso?
We
How are you
divide
going
it by the spot rate on the left, the lower spot rate.
to divide by the lower spot rate? Let's go to our question. Let's see. The lower spot rate is what here?
12.500.
Yes. So you can see this is the spot rate. 12.500. This is lower. 12.582 is the higher. So the lower is what you're going to divide with. So when you divide 4,819,277.108, what are you now going to have? Divide by 12.500.
$385,542.
542. So these amounts that you borrow, it will result into how much in the next 6 months? Because you are borrowing, you are going to pay interest on it.
Yes.
So
So it will result into 6/12 multiplied by the borrowing rates in our own currency. 10 plus 1 multiplied by 385,542, which will result to $394,217.
yes, so you are borrowing in your home currency. This is the rate, 4.5% per year. So you can see it's 4.5% per year. 4.5% per year. So now let's show it. We're not all on the same page. So let's show it. But that is as simple as it is. Yes. So once you follow that, if you go to your study pack, you see the stories they're writing, but it will lead you to the same. Well, I'm not interested in that story. So
Mr. Kappa, please.
yes, ma'am.
Excuse me, sir, please. If it is receipt, we'll borrow. If it is payment, we'll now move to the third box and deposit. Am I correct, sir?
Yes, ma'am.
I'm using
So
the table, yes. If it is receipt, we'll borrow.
yes,
We'll use the formula in the first box. If it is payment, we'll skip the second box and use the third box. Am I correct, please?
no, I'm trying to get the skipping part.
No, you're not skipping anything.
This is it. If it is payment, if it is payment,
If it's payment, yes.
you deposit.
We deposit. That is the third box, sir.
No, yes, it depends. Yes, it depends on how you are looking at it. Yes, this table is the amount you are going to deposit in foreign currency. In foreign currency, the amount you are going to deposit in foreign currency will be based on what you have in the first box. In the first box. So this foreign currency here, you need to know how much it will be in your own home currency. You know, this is foreign. So look at it. The upper part is foreign issue. The lower part is home issue. So if you have a value for you that you deposit in your foreign currency. Now, to you, in your own home currency, what would be the value of this foreign currency in your own home currency? So let me get the skipping part again. Let me get that part.
What I said was that,
Yes,
when we're the two examples we've done,
yes,
we was under receipt.
yes.
Amount was the first box. We now move to the second box and use the formula. Then the third box,
Mm-hmm.
I had we're saying the assets we will now borrow. When we borrow, we'll now deposit. Then we'll move to
Yes,
the last box for the payment. So
yes,
that of the payment now, this illustration we're about to solve,
yes,
we we are borrowing. Is payment we
yes,
want to pay back. We want to pay back.
yes. So we
We will now
deposit.
deposit. Yes,
Yes,
we move to is it the third the debt? Okay,
we
okay.
deposit.
All right. I interchanged mine. All right. That was what I was thinking. It was the third box we'll go to. Thank you, sir.
All
No,
right.
sir, it seems like she's not
Are there two
understanding. We
tables?
have this
Are there two
two. The
tables?
tables are two. There
Two
are two
tables.
tables. Yes,
All right.
that's
And
two
thank you
tables.
very much. All right. The
Same.
first table is for receipt. The second table is for payment. I
Yes,
didn't
ma'am.
know there was payment table. Thank you, sir.
All right.
All right. Please let me screenshot the payment table, please.
In case it's not clear, you can check the slide on the group.
Thank you, sir. Thank
Save
you.
it. All right. So now, going by this question, going by this question, we can also follow our table. We can follow the table solution. So the next question, after solving this, every one of you will attempt it. You solve it. You solve that question. So we have the foreign currency. Foreign currency. Now, in the foreign currency, how much are you paying in the next 6 months? In the next 6 months, you are paying how much? 500, 5 million pesos. Now, since you are to pay six in 6 months, 5 million pesos, what do you need to do to guide against fluctuation? You quickly make a deposit in that foreign currency. How much will you make? Will you deposit today? How much will you deposit today? And that deposit will grow to 5 million in the next 6 months. How much? It will be what? 5 million divided by what? 1 plus the R. And what is R? We are making deposits in the foreign currency. The deposit rate per year is what? Foreign
Seven.
currency
7.5, sir.
7.5. So we have it as 7.5. 7.5%. Now, this 7.5% is for a year. For you to get it in 6 months, multiply by 6 divided by 12. When you do this, you are going to have what?
4819277.
Okay, let's do it step by step. So let's have 5 million again. Divide by 1 point. When you do that, the denominator, you should have 1 point what? 1.0375. Isn't it? Then when you now divide, it will be what?
4819
Or 819,277.
277.
7.
So now, for you to pay 5 million in 6 months time, you can make a deposit of this amount. As you make a deposit of this amount, now the bank will give you interest on it that will result into 5 million perfectly in the next 6 months. So this is with foreign currency. Coming to your home currency. Coming to your home currency, what will happen? Because you are not in this, you are not having this peso. You are here in US. Understand? So now, what would be the equivalent of this in your own home currency? In your home currency. Now, the bank we need to sell you, or we need to buy from you. And if they are buying from you, it will be at what rate?
And the lower rate,
It will be at the lower rate, 12.5. 12.5. So just have the understanding that when you're making payments, you use the lower value, and when you are trying to receive, you use the higher value. So now, in home currency, 4,819,277 will be equivalent to what?
385,542.
So this will be equal to 385,542. Is it perfectly 542? So
1.1687.
okay, 1687, yes, approximately. If you want 1687, I just maintain this. Now, these amounts you make deposits in your own currency, it's equivalent to what? 385,452. So this value here, what are you going to do with it?
Deposit. No.
No, you borrow now.
Borrow.
So when you borrow, this will lead to what? When you borrow these amounts in your home currency, what will be the value? In home currency, the borrow rate is what?
4.5.
4.5.
You are in US.
Yes, yes, sir.
So 4.5% per year. Dollar interest rate borrow 4.5. So now when you borrow, it will now be what? It will now be 385,542 multiplied by
By
1
1 plus 4.5%
4.5%
times 6 over 12.
over 2.
multiplied by what? 6 over 12.
6 over 12.
So this will now give you what?
394,217.
394,217. 394 217.
217.
What it
Yes,
will
sir.
result to in your own home currency. This is what they want. So now, that is not what the question, that is not the end. Oh. The question says what? Calculate whether a forward market hedge, forward market hedge, forward market hedge. Now, for forward market hedge, what are you going to do? Forward market hedge. When we come to the 6-month forward rate, can you see 6-month forward rate? Can you see 6-month
Yes.
forward rate?
Yes.
6-month forward rate.
Yes, sir.
Okay, fine. 6-month forward rate. The 6-month forward rate. When you convert 5 million in foreign currency to your own home currency, which is dollar, based on forward rates, what will be the value? What
We're
will be
going
the
to
value?
divide 5 million. We're going to divide 5 million by the right hand side. That is the higher forward rate, and which is $387,928.
Okay, take note, this is payment, right?
Yes.
This is payment. So if this is payment, check it again. Which of these spot rates or forward rates are you going to divide with?
Yes.
The lower.
Lower.
Lower. Lower rate. So between 12.805 and 12.889, which is lower?
12.0805.
So the
12.
forward market hedge will be for you to convert dollar cost of peso interest using the forward market. It will be what? It will be 5 million divided by 12.805. So the simple formula for forward is your exposure value divided by the forward rate. The exposure value here is 5 million divided by what? The forward rate. So since this is a payment, we divide by the lower value. So what will be the results?
39472.
So the question is, you compare, yes, you compare the result 39472 with 39421. You compare the results. Which will be the higher value? So forward market here.
217.
Okay, so since this is payment, which one are you going to advise?
You
We are going to
advise
take the lower dollar value.
you should
So
edge.
we advise people to edge using the forward
Yes.
market edge because it has lower value.
Yes.
They are going to pay lower value.
Yes,
Going to pay lower value.
yes, using your dollar. If you know your background is noisy, just mute yourself. So we have forward market hedge. Forward market hedge. So the 6 months, 6 month forward rates for buying for buying pesos. The bank is buying, they'll buy at a lower rate. It's 12.805. 805. 12.805 pesos to $1. So the dollar cost now will now be what? The exposure value, which is what? 5 million. 5 million divided by what? 12.805. So the result will now be what? 390,472. So since this is payment, when you compare 390,472 to 394,217, you will discover that what? You will discover that the forward market hedge is lower than what? The foreign market hedge, the money market hedge. So it is better we pay using what? The forward market hedge. So you can write that comparing the value, comparing 390,472 cost of forward cost of the forward market hedge, cost of forward market hedge, cost of forward market hedge with the is 394,217. 217 costs of using money markets. It is clear. It's clear that forward markets should be used to hedge the peso to hedge the peso. To hedge the peso. Because
Hello, sir.
as it is clear, and with you, ma,
Forward contract on forward market.
as it is cheaper.
It's the same thing.
As it is cheaper. So what is the difference? It is cheaper by what now? It is cheaper by the difference between the two values could be 3.745. Let me just add forward market hedge here so that but it's same ma.
So the difference is 3,745.
3,745, right?
Yes, sir.
All right. So that is it.
So I have a
So
question.
yes, what is the question?
What's the decision rule? for forward market and money market hedge.
The decision rule is this. If you are to make payments, whichever is lower in your own home currency should be the one you have to go with. If forward market is lower, you go with forward market. If money market hedge is lower, you go with it in terms of payment. In terms of receipt, that is you receiving money. If forward market is giving you a higher value, you go with what? The forward market. If money market hedge is giving you a higher value, you go with the higher value. So that is the decision rule.
Okay, sir.
So from what we've displayed here now, using money market and forward market hedge, because this is payment, this is in form of payment, we are to go with what? The hedging techniques that will pay less, and which is the forward market hedge. Forward market hedge. What is your question, sir?
Okay. So please, it wasn't network. It was just a distraction. I was a bit distracted. Well, I was a bit distracted when you were explaining that forward rate. I didn't get the reason why we used that 12.805. But I was following you. I was copying. So I said after I will ask.
Okay.
Just a recap.
The reason we are using 12.805 is that the bank is buying. And when the bank is buying, the bank will buy at a lower rate. You need to sell the foreign currency to the bank so that you can get a local currency. So the bank will buy from you. And when the bank is buying from you, your bank will buy at a lower value. And the lower value based on the 6-month forward rate is what? 12.805. 12.805. And that is why we are using this 12.805.
Okay. All right.
So moving to this question, that Nedwin Co. is a UK-based company which has the following expected transactions. 1 month expected receipt of $240,000. 1 month expected payment is $140,000. At this point, let me ask, what will be the net receipt in terms of 1 month? What will be the net receipt? Because you have payment and you have receipt within 1 month. What will be the net receipt? What will be the net receipt? It's just plus and minus now.
100,000.
Yes, 100,000. Because within 1 month, you are expecting a payment. Within 1 month, you are expecting a receipt to receive money. So at the end of the 1 month, how much will you have? That is a net receipt. It will be 240 minus 140. And that will give us what? 100,000. That is your net receipt in 1 month. So now 3 months expected receipt. We have what? $300,000. The finance manager has collected the following information. Spot rates, dollar per pounds. We have 1.7820 plus or minus 0.002. This 0.002 is the spread. This is the base value. Now, when some people see this, they'll begin to ask, what is the meaning of this? Plus or minus 0.002. So when you see plus or minus 0.002, it means the higher value will be what? 1.7820 plus 0.002. Then the lower value will be what? 1.7820 minus 0.002. Please, do you get, please?
Yes, sir.
Yes.
No, sir.
No, sir.
Come again.
No.
So now I'm saying that when you see a question in this form, that spot rates dollar per pound is 1.7820 plus or minus 0.002. Instead of them giving you in this form, they didn't give it to you. It's still same thing. This plus or minus means that what? When you add 0.002 to 1.780, what will be the result? When you less 0.002 from 1.7820, what will be your result? So the two results, you have a higher value and you have what? A lower value. So when you add 0.002 to 1.7820, you have a higher value. That will be the spot rate based on the higher value. The spot rate based on the lower value will be what? 1.7820 minus 0.002. So this 0.002 is just the spread, the difference. So instead of working it for you, they want you to determine it. So when you see plus and minus, don't run away. Is simply the higher value will be what? 1.7820 plus this value. The lower value will be what? 1.7820 minus this result. And that is why I can see plus or minus here. Plus or minus. So, in this case, directly is given to you. Spot rate is 12.500 to 12.5820. But in this case now, it's just for you to add 0.002 to this to have the higher value. To get the lower value, you less 0.002 from 1.7820. That is the meaning of this plus or minus in this question.
So
And
why are
for
they
1 month,
complicating it? So
are you asking a question?
yeah, I just said why are they complicating it? They're
No,
just
it's not
looking it up.
complication now. You're a professional. When you start working in Nigerian Stock Exchange and you're expressing information in this form, it's not complication. It's just for you to be versatile. Yes.
Okay.
It's, a layman should not interpret, should not have knowledge of your work ethics. At least you should have some kind
Awareness.
power over a layman. So when a layman sees this and what is this? So yeah, this accounting is hard though. You just smile. You just you understand. So it's not
Okay.
complication. It's part of learning.
Okay, sir.
So 1.7820 plus or minus. So you should know that okay, the higher value will be the addition of this to this, the lower value will be the deduction of this from this. So same for others. So money market rates for Newden Co. We have borrowing and deposit. 1 year sterling interest rate. We have it when you want to borrow, it's 4.9%. When you want to make a deposit, it's 4.6%. 1 year dollar interest rates. If you want to borrow in dollar, it's 5.4%. If you want to make a deposit, it's 5.1%. So required. Discuss the difference between transaction risk, translation risk, and economic risk. I've explained this before when we introduced this during the normal class. So what is transaction risk? What is translation risk? What is economic risk? If you go through the SFN Pathfinder, you'll see this question there. They are asking them as simple as it is that what is transaction risk? What is translation risk? And what is economic risk? So this morning, I'm asking us in this class, somebody should explain what is transaction risk? What is translation risk? What is economic risk? So who can tell us what they are? It's revision now. Expected to have known everything by now. Mr. Priest, Oga Priest. Okay. And I'm Chuma. Speak to us, please.
So I just want to just throw a point to, like in my own understanding, transaction risk deals with the buying of the currency. What you encounter, either the increase in the price or the reduction in the price, depending. Then translation is like conversion of the currency. So that's just what I can say now. Just a slight point.
Okay. There's somebody
Hello,
else.
sir.
Yes, ma.
I think transaction risk is the risk that occur when the contract is signed and when the payment is being made.
Okay.
I don't know. Then translation risk is also an accounting risk. It's
Okay.
a risk for as in foreign subsidiaries.
Okay.
Let me try it, sir.
Transaction, okay.
Yes, right on.
Transaction risks, they are the risks arising from the exchange rates between the transaction date and the settlement date. We are going to have a date where the transaction is made and then the date where they are going to make payments. So, and this actually affects the cash flow. And then translation risks, this is the risks that occur as a result of subsidiary subsidiary company trying to convert into its parent company. So for reporting purposes, and this is accounting risk. While economic risk is a long-term exchange rate movement. So this is a risk that affects the competitiveness, the totality of a company, like for unforeseeable circumstances like war, inflation, all those are economic risks.
I think you've watched that video very well. I
Hello?
think I can recall. These are my words from that video.
Hello?
Especially, okay, sir, I'm with you, sir.
I watched it
Shebi,
very well.
sorry, Adam.
Right on, sir. I can hear you, sir.
Hello, sir. Please, network threw me out. That's why I couldn't say anything. Though. I'm so sorry, sir.
No problem, sir. You know you're in US now. Based on the fact that we are treating foreign exchange, you're in US. Your network should be stable, sir. All right, no problem, sir. Yes, so let me just divert a little. Which IAS is talking about translation risks? For those of you doing FR, which IAS? For those of you that are writing FR, they can just ask you some of these things. What is the recognition criteria? What is this, that? So IAS, what is talking about? Even for those of you that have passed FR, the fact that you've passed FR shows that you are worthy of that pass. So which IAS is talking about
IS
translation?
10.
IS 10? IS
IS
10?
IS 3. IS 3 and
21.
28.
Okay. IS 21. That is the effect of changes in foreign exchange rates. That is IS 21. As accountants, this should be right with us, even though after the exam, some of us do forget most of this standard because we are not working with it daily. But for you to grow in this profession, especially if you are working in the private sector, you must have this standard at your fingertip, and because this will be your Bible and what you work with. And that is why in ACCA, they have even in ICANN, we have a special class for standard for those that are practicing, and they give certificate for it on these standards. So like a special class, even after you are chartered, you can always go for a refresher course in Lagos on application of each of these standards to your daily tasks. So I can see your hand up, Madam Chikodili Roots. Is it that you want to? The answer is on the screen. You know, it's part of the slide I put forth the first time we were teaching this class: transaction rates, translation rates, economic rates. So please, as I always say, the exam is a blend of calculation and theory. So any theory you see, attack it. Attack it. Either you heard about it before, just calm your head down, reason something, write a valid point. So don't leave anything undone in these exams, because at least let's pass. Let's pass. So going back to this question, going back to the question, going back to this question. So discuss the difference between transaction rates, translation rates, and economic rates. Explain how inflation rates can be used to forecast exchange rates. Calculate the expected sterling receipt in 1 month and in 3 months using the forward market. Using the forward market, and calculate the expected sterling receipt in 3 months using money market hedge, and recommend whether a forward market hedge or a money market hedge should be used. Discuss how sterling currency futures contract could be used to hedge the 3 months dollar receipt. So based on this question, from point C, that we should calculate the expected sterling receipt in 1 month and in 3 months using forward markets. So what are we going to do? Using forward markets. Using forward markets, what will be the receipt in sterling? What will be the receipt in sterling? This is a very straightforward one now. What will be the receipt in sterling in 1 month's time? Now you are receiving in 1 month time. What will be the sterling receipt? So our net receipt is what in 1 month?
100,000.
100,000. So the pound sterling value in the next 1 month will be what?
1.7832.
1.7832. Yeah, that is a spot rate. Yes. So when you use that value to convert $100,000 to pound sterling, what will you get? What will you have?
78,511.
78,511. That is 100,000 divided by 1.7832.
No, 140 divided by 1.7832.
No, your net receipt now. You know, in this 1 month, you have 240 as receipt. You have payment as what? 140. So your net receipt will be 240 minus 140. You have what?
100,000.
So is that 100,000 you work with?
Okay.
You understand?
Yes, sir.
56,079.
Yes. So solution. Forward markets. Forward markets. Net receipt. Net receipts in 1 month. Forward market net receipt in 1 month. So the net receipt in 1 month will be what? Net receipt in 1 month. We have it net receipt 1 month will be equal to what? 240 minus 140. And this will give us what?
$100.
$100,000. So now, from the question that calculate the expected sterling receipt, now you are expected to receive sterling, pound sterling, but you're expected to receive dollars, but your own home currency is what? Is pound sterling. When you receive this, your pounds, these your dollars rather, what will you do with it? What will you do with it? You cannot use it in your own home currency. You need it in pound sterling. You need it in pound. So since it's receipt, are you using the higher value or the lower value?
Higher.
The higher value.
So now, based on this question, in 1 month, your higher value will be what? Spot rate 1.7820 plus 0.002 will give you the higher value.
1.7822.
Okay,
1.7822, the higher value.
Okay.
That is the payment. I'm
Yes.
using
So
payment.
are you
3-2. 3-2.
sorry?
1.78.
Yes, 832. 1 month forward rate, please. 1 month forward rate. Say it. 1 month forward rate. So we have
1.7832.
So we now have it as what? 1.78.
32.
Exchange rate will be equal to 1.7832. Let's show how we arrive at that. 1.7829 plus what? 0.003 to give us what? 1.7832. 1.7832. Now, what will now be your sterling value? Sterling value
100,000.
will be what? The sterling value will be 100,000 divided by what?
1.7832.
1.732. And this will give us what?
56,079.
56,079. So this will be the pound sterling value. This will be the pound sterling value in 1 month. In 1 month. So in 3 months, what will be the receipt in 3 months? My time is almost up. What will be the receipt in 3 months? 3 months forward rate. What will be the receipt in 3 months? In pound sterling. You have $300,000. In 3 months in pound sterling, it will be what? In 3 months, receipt in 3 months will
It's
give
going
us
to
what?
It will be
168,067.
168,067.
Yes, that is correct. So receipt in 3 months. So the exchange rate will be what?
168,067 pound sterling.
So 1.78 46 plus what? 0.004.
Sorry, sir.
Plus
So we now have it as what? 1.78.
1.785.
So when you want to
Sorry, sir.
yes,
So if I understand correctly, this 100,000 is for 1 month. So just multiply by 3 for the 3 months.
No, the
100,000.
$300 is in the question.
The
Okay,
hundred
$300
the $100 is receipts minus payments. So
No,
in the
I understand. I'm talking about the 300.
The
It's in the
300 is
question.
in the question.
See it's 3 months
If the 100 is
expected.
for a month, okay, is in the question. Thank you.
So the question is saying calculate the expected selling receipt in 1 month. So in 1 month, you see, we have 1 month values, right? So the net receipt for 1 month is 240 minus 140 is 100. So we computed that, we are done with that.
Yeah.
Now we're now looking at in 3 months.
Okay.
In 3 months, what are the issues of 3 months? $300,000.
Yeah.
So coming to the forward rate too. Forward rate based on 3 months is what? 1.78.
Plus
Yeah.
0.004.
Yeah. Since we are receiving, you understand? We use the higher value, and that is what we are doing here. That is what we are doing here. So now, the next thing will be what here? Since we have the exchange rates, we now have it as what? What will be your sterling receipt?
$300,000 divided by 1.785.
So sterling receipt will now be what? Is $300,000 divided by what? 1.785.
1.785.
And we're going to have what in pounds?
468,067 pounds.
Pounds. So this is the forward analysis. Forward analysis.
Hello, Mr. Tope.
Yes, ma'am.
It's like the calculation for exchange rate is not correct.
Okay, what?
1.7846 plus 0.004. It should give
Okay.
us 1.7886.
Okay. Somebody should confirm, please.
Which one?
This
Exchange
1.7846
rate.
plus 0.004.
Is correct.
It's correct at
You should check our calculator.
1.785.
Seeing it already, I know it's correct because when you put 00 and 4, you have 0
That
there.
is correct, but that is 0.0004. That's 00. You need to add 10.
Okay.
Is a 3 zeros. Yes.
So 30 from the question here. So now,
Thank you, sir.
the next thing, I might not conclude these other parts. You go and solve it and send your solution to the, is what we've done. Calculate the expected selling receipt in 3 months using money market hedge and recommend whether a forward market hedge or money market hedge should be used. So you go and solve this aspect is what we've treated. Discuss how sterling currency futures contract could be used to hedge the 3 month dollar receipt. This is discussion. So you also discuss. So please go and solve these D and E parts. I'll be expecting your solution. I'll revert back. I'll expect your solution before 10 so that I can assess what you've done and tell you that yes, you are fine. So please do well to solve that. and go over the first class on foreign exchange, the one we treated, so that you have this better understanding. You know, that aspect we treated during the normal class is different from this. I intentionally didn't treat this during the normal class so that you can watch the video, because the issue of foreign exchange is very much and complex. So I don't want to pull everything together as a point. If not, you will not appreciate this topic. But by the time you do it in piecemeal, the students will appreciate it more rather than pulling everything together. So please go back again to revise what we've done during the normal class, and also watch this and be well grounded in this. I believe you can see that this is not difficult. Yes, it's just for us to calm down and understand the question. So when you see question on foreign exchange risk management, it should be very much you should be very much okay with it, because you still see this in SFM again. And when you see it in SFM, it will also come in this approach. And I think at that point, your understanding should be much more better. So thank you very much. I have to go now.
Thank you,
See
sir.
you.
Hello, sir. We are
Thank you, sir.
waiting.
Have a
Thank you,
class,
sir.
so
Thank you,
Yes,
sir.
God bless you.
Thank you, sir.